Good morning. Rahul Jha welcomes you. Today we are going to talk on shares. Why to invest in share? Shares can be a valuable part of your investment portfolio. Owning stocks in different companies can help you build your savings, protect your money from inflation and taxes, and maximize income from your investment. It's important to know that there are risks when investing in stock markets. So, point is that what are shares? Shares are units of ownership in a company. The term shares, stocks are often used interchangeably, but they represent a company differently. While this may seem confusing, it is a matter of how you are talking about a company and how much ownership you have in it. For example, say XYZ company issued stock and you purchased 10 share of it. If each share represents 1% of ownership, you own 10% of company. The company issued stock and you bought shares of it. Another way to think it as that you purchase shares of stock, you don't buy stock. Stock is a more general term used to refer to financial instruments a company issue, while shares are what you actually buy. Key takeaways: shares represent units of ownership in a corporation of financial assets owned by investors who exchange capital in return for this unit. Common stock shares enable voting rights and possible return through price appreciation and dividends. Preferable stock shares do not offer price appreciation but can be redeemed at an attractive price and offer regular dividends. Many companies issue shares, but only the shares of publicly traded companies are found on stock exchanges. So let's understand what is share. When establishing a corporation, owners may choose to issue stock to raise capital. Companies then divide their stocks into shares which are sold to investors. These investors are generally investment banking or brokers that in turn sell the shares to other individual investors or through instruments like a mutual fund or exchange traded fund ETFs. Shares are equivalent of ownership in a corporation because they represent ownership, not debt. There is no legal obligation for the company to reimburse the shareholders if something happens to the business. However, some companies may distribute profits to shareholders through dividends. Others may not, deciding to use all profits to operate, grow, and secure their futures. Founders, partners, or specific employees like executives generally own shares of privately held companies or partnership. So, how shares are issued and regulated? Generally, a company's board of directors is given a specific number of shares that can be issued. These are called authorized shares. Issued shares are the number of shares sold to shareholders and counted for ownership purpose. So a corporation might have 10 million authorized shares but only issued 8 million shares. Because shareholders' ownership is affected by the number of authorized shares, shareholders may vote to limit that number as they see appropriate when shareholders want to increase the number of authorized shares. They meet to discuss the issue and establish an agreement. When they agree to increase or decrease the number of authorized shares, a formal request is made to the state through filing article of amendment. The shares of publicly traded companies are listed on public exchanges, generally through a process called initial public offering (IPO). This is an expensive, highly regulated, and lengthy process in which a company goes through fundraising phases and scrutiny by regulators. Private companies, the shares are generally issued through company stock options or as other incentives to certain employees. These shares are still regulated but usually do not meet the Security and Exchange Commission's criteria to be listed on an exchange. The issue of distribution of shares in public and private markets are regulated by Securities and Exchange Commission (SEC). Share trading on secondary market is overseen by SEC and then it is regulated by SEC. Types of shares. Any company can issue shares, but publicly traded companies are more likely to divide their stock into shares. What are different types of shares? Broadly, there are two types of shares: equity shares and preferential shares. Equity shares. Equity shares are also referred to as ordinary shares. They are one of the most common kind of shares. These stocks are documents that give investors ownership rights to the company. Equity shareholders bear the highest risk. Owners of these shares have the right to vote on various companies' matter. Equity shares are also transferable and dividend is paid of proportion of profit. One thing to note is that equity shareholders are not entitled to a fixed dividends. The liability of an equity shareholder is limited to the amount of their investment. However, there are no preferential rights in holding. Equity shares are classified as per types of share capital. Authorized share capital. This is maximum amount of capital a company can issue. It can be increased from time to time. For this, a company needs to conform to some formalities and also pay fees to legal entities. Issue share capital. This is a portion of authorized capital and less than authorized capital which a company offers to its investor. So a company can issue shares which is less than or equal to authorized capital. Subscribed capital, share capital. This refers to portion of issued capital upon which investor accept and agreed. Paid up capital. This is portion of subscribed capital for which investors pay. Since most companies accept the entire subscription amount at one go, issued, subscribed and paid capital are the same things. There are a few other types of shares like a right share. These are kind of shares a company issues to existing investors. Such stocks are issued to protect the ownership right of the existing shareholder. Bonus share. Sometimes companies may issue shares to their shareholders as a dividend. Such stocks are called bonus shares. Sweet equity share, or rather sweat equity share. When employees or directors perform their role exceptionally well, sweat equity shares are issued to reward them. Preference shares. In our discussion on what type of shares we will look at preference share. When a company is liquidated, the shareholders who hold preference shares are paid off first. They also have a right to receive profits of the company before ordinary shareholders. Cumulative and non-cumulative preference shares. In the case of cumulative preference share, when the company does not declare dividend for a particular year, it is carried forward and accumulated. When the company makes profit in future, these accumulated dividends are paid first. In case of non-cumulative preference shares, dividends do not get accumulated, which means there are no future profit, no dividends are paid. Participating and non-participating preference shares. Participating shareholders have right to participate in remaining profits after the dividend has been paid out to equity shareholders. So in years where the company has made more profits, these shareholders are entitled to get dividend over and above the fixed dividend. Holders of non-participating preference shares do not have right to participate in the profits after the equity shareholders have been paid. So in case of a company makes any surplus profit, they will not get additional dividend. They will only receive their fixed share of dividend every year, convertible and non-convertible preference share. Here the shareholders have an option of right to convert these shares into ordinary equity share. For this, specific terms and conditions need to be met, and non-convertible preference shares do not have right to be converted into equity shares. Redeemable and irredeemable preference share. Redeemable preference shares can be claimed as or repurchased by issuing company. These can happen at predetermined price and at a predetermined time. These do not have a maturity date, which means these type of shares are perpetual. So companies are not bound to pay any amount after the fixed period. Understanding shares meaning and type will help an investor understand how the stock market works. Common stock shares. Many companies issue common stock which is divided into shares. These are generally called common shares. These provide the purchasers called shareholders with a residual claim on the company and its profit, providing potential investment growth through both capital gains and dividends. Common shares also comes with voting rights, giving shareholders more control over the business. These rights allow the shareholders of the company to vote on specific corporate actions, elect members to the board of directors, and approve issuing new securities or payment of dividends. In addition, common stock can include preemptive rights, ensuring that the shareholders may buy new shares and then their percentage of ownership when the corporation issues new stocks. Preferred stock shares. Preferred stock can also be divided into shares, commonly called preferred shares. Compared to common shares, preferred shares typically do not offer much market appreciation in value, voting rights in the corporation. However, these type of stock typically has a set payment criteria, like a dividend paid out regularly, making the stock less risky than common stock. Because preferred stock take priority over common stock, if the business files for bankruptcy and is forced to repay its lender, preferred shareholders seek payment before common shareholders but after bond holders. This priority treatment reduces the risk even further compared to common shares. So what are shares in simple words? Shares represents a unit of ownership in the business that issued them. What is different between share and stock? A stock is an equity instrument issued by corporation. It is divided into shares which then represent ownership. So do share make money for you? Common shares can make money through capital gain or buyback. Preferred share can make for you through dividends or higher buyback prices, the bottom line. Shares are units of stock issued by the corporation that represent ownership. They are sold to investors and traded to raise capital for the company. Many businessmen issue stocks and shares when they need funds for research and development, expansion, or other growth opportunities. We often hear active investor limit the time and energy they spend identifying trade candidates. But with many stocks to choose from, there are number of shares on the stock exchange. So how to choose the good shares? We may take 5 steps for this. First, assess the market. Before we add a position, note how the broader market is moving since research suggests that roughly the 75% of stocks move in steps with market. Just like a rising tide lifts all boats, buying stocks when the market is trending higher may increase your odds of a successful trade. Next, look at a major index moving average, which shows the general trend in price over the given period to determine the market's momentum. If you trade time frame in 2 months, for example, you might look at 50-day moving average on any exchange in order to gauge the market general direction over the period. Pay attention to potential market moving events that could affect your trade, such as policies by government or earning announcements. Second is identifying a sector. Once we have general picture of market, home in the sector and industries that look particularly promising, one approach is to track the performance of each sectors defined by global industry classification standards to see which have excelled in recent months. If the trend indicates possible difficulty ahead, you might want to focus on sectors or industries with more defensive characteristics such as healthcare or utilities. It also can be helpful to consult a good consultant which provides you good consultancy. Screen for stocks. After we have found a sector, it's time to look for individual stocks. To further narrow the list, try focusing on growth or value candidates. Growth stocks tend to have higher valuation that reflect the company's potential, while value stocks tend to have lower prices related to current fundamentals. If you are interested in growth, you might screen for factors such as historical or projected growth rates. If you care more about value, you might screen for low price to book or price to earning ratio. Next is review of fundamentals. With a short list of candidates in hand, it's time to dig into details. First, check the investment commentaries available for each company. Are there any red flags such as product recall or litigation against the company that could negatively impact the price? Conversely, are there factors such as a product launch or the announcement of the pending takeover that suggest the stock price could rise further? You might also look into each company's earning, financial statements and ratings. Don't go overboard, though the goal is not to learn everything you can about each company, but rather to identify details that might set one stock apart from another. Check the charts. Once we have whittled our list to the most promising candidate, look at each stock's trend line. In general, it's good time to get into trade if you can either buy into an uptrend or alternatively buy into a dip if you have reason to believe the decline is an anomaly. As you fall in rhythm with your stock selection process, these steps should become second nature. But whatever methodology you apply, keep careful track on expectations and reasons behind every trade. The better to learn from both your failures and your successes. What is stock analysis? Stock analysis is the evaluation of particular trading instrument and investment sector or the market as a whole. Stock analysis attempt to determine the future activities of instrument, sector or market. So key takeaways. Stock analysis is a practice of using information and analyzing data to invest or make investment decision. One popular form of stock analysis is fundamental analysis, the practice of using financial activity to forecast stock prices. Another popular form of stock analysis is technical analysis, the reliance of historical stock prices activity to predict future price activity. Other less common forms of stock analysis include sentiment analysis and quantitative analysis. Investors may have unpredictable or limited information, which makes stock analysis difficult. Understanding stock analysis. Stock analysis is a method for investors and traders to make buying and selling decisions. But studying and evaluating past and current data, investors and traders attempt to gain an edge in the market by making informed decisions. The notion of stock analysis relies on the assumption that available market information can be used to determine the intrinsic value of stock. In the primary market discussed below, investors use financial statements, stock price movement, market indicators, or industry trends to make investment decisions. Much of this strategy relies on leveraging historical information. For instance, investors may analyze a company's stock based on the financial performance. An analyst that is trying to determine the fair price of stock may strive to understand how similar companies of similar performance performed in the past. There are basically two types of stock analysis: fundamental analysis and technical analysis. Now we'll discuss each method more in depth. Fundamental analysis. Fundamental analysis concentrates on data for sources including financial records, economic reports, company assets, and market shares. To conduct fundamental analysis on a public company or sector, investors and analysts typically analyze the metrics of company, the financial statements, balance sheets, income statement, cash flow statements, and footnotes. These statements are released to the public by government or stock exchanges or SEBI through the database system. Now, also earning reports released by company during its quarterly earning press release is analyzed by investors who look to ascertain how much in revenue, expenses, and profit a company made. Companies often release their financial statement information on set with predictable release period. Fundamental analysis and ratio. When running stock analysis on the company financial statement, an analyst will usually be checking for the measure of the company's profitability, liquidity, solvency, efficiency, growth trajectory, and leverage. Different ratios can be used to determine how healthy a company is. For example, the current ratio and quick ratio are used to estimate whether a company will be able to pay its short-term liabilities with its available current assets. The formula for current ratio is calculated by dividing current asset by current liabilities. Figures that can be gotten from the balance sheet. Although there is no such thing as an ideal current ratio, a ratio less than 1 could indicate to the stock analyst that the company is in poor financial health and may not be able to cover its short-term debt obligation when they come to due. Looking at the balance sheet still, a stock analyst may want to know the current debts level taken on by the company. In this case, a stock analyst may use debt ratio, which is calculated by dividing total liabilities by total assets. The debt ratio above 1 typically means the company has more debt than assets. In this case, if the company has a high degree of leverage, a stock analyst may conclude that the rise of interest rates might increase the company's profitability or probability of going into the default. Fundamental analysis and comparative information. Stock analysis involves comparing a company's current financial statement to its financial statement in previous years to give an investor a sense of whether the company is growing, stable, or deteriorating. The financial statement of the company can also be compared to that of one or more companies within the same industry. The stock analyst may be looking to compare the operating profit margin of two competing companies by looking at their income statements. Operating profit margin is a metric that shows how much revenue is left after. Operating expenses have been paid after the portion of revenue is left to cover non-operating costs and is calculated as operating income divided by revenue. A company with an operating margin of 0.30 will be looked into more favorably than with a margin of 0.03. A 0.3 operating margin means that for every dollar or rupee of revenue, a company has 30 paise left after the operating costs have been covered. In other words, a company uses 70 paise out of every rupee in net sales to pay for its variable and operating costs. Technical analysis. The second method of stock analysis is technical analysis. Technical analysis focuses on the study of past and present price action to predict the probability of future price movements. Technical analysis analyzes the financial market as a whole and are primarily concerned with the price and volume, as well as the demand and supply factor that move the market. Charts are the key tool for technical analysis, and they show graphical instruction of stock, how it trends within the specific time period. For example, using a chart, a technical analyst may mark certain area as support or resistance level. So we can earmark some support or resistance level using this technical chart. Support levels are marked by previous lows below the current trading price, and the resistance marker placed at previous highs or above the current market price. A break below supporting level would increase bearish trend to the stock analyst, while the break above the resistance level would take on a bullish outlook. Technical analysis and comparability. Technical stock analysis is effective only when supply and demand forces influence the price trend analyzed. When outside factors are involved in the price movement, analyzing stocks using technical analysis may not be successful. Like other forms of analysis, analyzing stock price trending using technical analysis is most complicated as more variables are considered. Examples of factors other than supply and demand that can affect the stock price include stock splits, mergers, dividend announcements, a class action suit or death of company CEO, a terrorist attack, accounting scandals, change of management, monetary policy changes, or many other news that may affect the market and sentiments of the country as a whole. These unpredictable events may occur that are essentially impossible to forecast or plan for. So company might be performing very well, but if any mishappening happens in the market or in a country, then there are chances that market may fall or price of share may fall. So technical analysis is only possible if the company historical stock price can be used to predict future price movement. But beware, this is not the final thing. Best of the company's performance and everything looking very bright, but if environment is not good for in the country or in the financial scene of their country, then shares may not perform as they look like. So even having best of the performance, shares of that company may fall if environment is not favorable. Other forms of stock analysis. Aside from fundamental analysis and technical analysis, analysts can leverage other less formal ways to analyze the price of stocks. With the interconnectivity and complexity of social media, analysts can perform sentiment analysis by engaging with social media and news to gauge public perception of the company. Quantitative analysis is similar to technical analysis in that it relies on complex financial calculation to determine future price projections. Quantitative analysis relies on mathematical and statistics model to review data. The goal of these models is to identify general trends based on what has happened in the past, not necessarily tied to especially to the stock price. Analysts may also perform either a top-down analysis or bottom-up analysis. Top-down analysis requires an analysis of overall company, then narrows down to the specific performance of the company. On the other hand, bottom-up requires analyzing individual companies, then reviewing how the broader economy is performing. Both types of analysis are used to more generally understand factors that impact price, such as broad market conditions. Limitation of stock analysis. Many investors rely on stock analysis by deploying their best investment strategies. However, stock analysis may result in misplaced confidence or misguided strategies. Stock analysis is often performed with limited information. This is due to a few reasons. First, public companies may not fully disclose all situations of their company to general public. Second, stock analysts strive to project the future, in which the information is simply not available. Because of this reliance on future events to occur, there is broadly uncertainty around all stock analysis techniques. The stock market may rapidly change in each direction based on prevailing market conditions. For example, should political climate change rapidly and redefine political risk, there may be an unpredictable impact to investment no previously foreseen. As analysis digs into stock data, there is always an inherent risk of bias. If the data being analyzed is not anonymous, analysts may find themselves favoring certain outcome based on what they know about investment option. In addition, analysts and investors may be lured to confirmation bias that steers decision to make a desired outcome. Last, stock analysis is often complex. It isn't easy to pull together and it requires a substantial amount of time. In addition, as variable changes every day, stock analysis requires continual thoughtfulness and analysis to evaluate morphing conditions. Which stock analysis technique is best? Investors may be best suited to use fundamental technical and quantitative analysis, as one technique may not always be superior compared to other techniques. Based on the information available and objectives of the investors, it may be better to analyze financial position, research and company industries, or devise complex financial models. How do you know if the stock price will go up? The best answer to the question is that nobody knows whether the stock price will go up or down. However, analysts and investors can leverage information to make the best, most strategic decision to follow general information related to stock. In general, if the fair value of stock is less than the current price of stock, the price will go down. On the other hand, companies with higher fair values as determined by the market will go up. How can a beginner start analyzing stock? Analyzing your first stock does not need to be difficult. First, gather as much public information related to the company as available. This includes recent news articles associated with the company as well as most recent set of financial statements. Then filter down this information to the most relevant information. Consider leveraging industry averages or data for competitors to set benchmarks. Then decide whether the company is outperforming or underperforming compared to current price and stock activity. So how do you research stock before buying them? As an investor researching stocks, you should aim to collect a broad range of information about the company. This includes recent government filings, news articles, press release, statements or activity of social media, and the company's financial statements. You can also leverage information from other analysts, as professionals may publicly give this or their opinion about the position of the company. This insight can be used to form your own opinion on future price movement. Bottom line, both fundamental and technical analysis can be done independently or together. Some analysts use both methods and analysis while others stick to one. Either way, using stock analysis to vet stocks, sectors and market is important. Method of creating the best investment strategy is one of the portfolios and investment strategy for one person's portfolio. Here are the six essential steps that you need to perform to analyze the fundamentals of the company in the Indian stock market. They are really simple yet effective to find fundamentally health of the company or find the healthy companies. Here it goes. Use the financial ratios for the initial screening, understand the company, study the financial result of the company, check the debt and red flags, find the company's competitors, analyze future prospects. A better approach is to shortlist a few good companies based on a few criteria, and then to study the screen companies one by one to pick the one that suits you best. A better approach is to first to shortlist a few good companies based on a few criteria, and then to study the screened companies one by one to pick the one that suits you best. Once you have understood the company and found it is appealing, next you need to check the financials of the company like balance sheet, profit loss statements and cash flow statements. As a thumb rule, revenue, sales, net profit and fine margin increase for the last 5 years can be considered as a healthy sign for the company. After that, you also need to check the other financial like operating cost, expenses, asset liability, etc. Now, where can you find the financials of the company that you are interested in to invest? One of the websites to check the financial statements of the company that I have found very suitable is TradeBrains portal. Here are the steps to check the financial result of the company. Go to site, any good site, enter the company's name in the search box. Company's detail will open like key ratio, profit and loss statement, balance sheet, cash flow statement, quarterly statement, peer companies or etc. Study the company's financial result for the last 5 years. It is required that you study the financials of the company carefully in order to select a good stock for long-term investment. If you do not know how to read the financial of the company, you can check and consult some good person who can guide you. Check the debt and red flags. The total debt in the company is one of the biggest factors to check before investing in a stock. A company cannot perform well and reward its shareholder if it has huge debt. They have to repay their debt and also pay interest on the borrowed money after anything. In short, avoid companies with huge debts. As a thumb rule, always invest in a company which has debt to equity ratio of less than 1. You can use this ratio in initial screening of the stock or else check it by reading the financials of the company. In addition, also other red flags in the company can be continuously declining profit margin, low liquidity and pledging of shares. Next is find the company's competitors. It's always good to study the peers of the company before investing. Determine what this company is doing that its competitors aren't doing. Further, you should be able to answer the question that why you invest in company that and not of its competitors. The answer should be convincing one like unique selling point, competitive advantage, low cost products, brand value, future prospects, upcoming projects, new plant, etc. You can find just the list of competitors of the company on some good sites, some good portals. Just enter the stock name or the search box and navigate down. You will find the peer comparison there. Else you can do a Google search to find the competitors of the company. Study the competitors in detail before investing. Most good investments are based on the future aspects potential of the company and hardly on their current situation. Investors are interested in how much returns they can get from their investment in the future. Therefore, always invest in a company with a strong long future prospects. Select only those companies to invest whose product or services will be still be used 20 years from now. Moreover, there is no point in investing in a CD or pen drive making company with no long term, say 10 years from now prospects. With cloud drives evolving so fast, these products will become obsolete with the time. So, while investing, you must always see that what is future of that product. Will it be there 10 years from now, or new product will come and this product will not sell? So this is a major decision that you must take before investing in a stock. If you are planning to invest for long term, then the long life of the company's product is a must criteria to check. Further, check future prospects, expansion possibilities, potential source of revenue in the future, etc. And this was the details of how this in share. So now I will be telling you what is the best sector that is going to perform in future. Best sector I see is the renewable energy sector. As you know, energy is must for anything we do. Either we need lighting for our houses, or we want to drive vehicles, or say anything, energy is a must. So invest in company which belongs to energy, and that too renewable energy, because focus of the world is on renewable energy, that is to decrease pollution, and renewable energy sources such as solar energy, wind energy, and hydel energy to some extent, hydrogen as a fuel. These are sectors which are going to be great in next 10 years or 20 years or even 30 years. So these are must. Other sector is energy storage companies or energy distribution companies. These will also be in focus for next 20 years. Besides this, companies with using artificial intelligence, or which belongs to artificial intelligence sector, and consumer goods sector are also very promising, and for next 20 years they will be in demand. So these were sectors most promising according to me, and that's all. Thank you.